All right, welcome back. So I've spent a bunch of time over the weekend testing this new confluence on my Virgin Wick theory model, and the results were quite good. So in this video, I'll go over what it is, how it works, and what updates I'm changing to my model to double its edge, essentially. So a quick overview of the model first. This is a long example, but essentially we want to wait for any virgin wicks, which are wicks that have not been touched before, that have not been ran through. So if you draw a line to the right, it has not been touched, like this one, for example, that is a virgin wick. So a virgin wick gets closed through by a Chad candle, in this case, a bullish Chad candle. Then we drop down to the 1 minute time frame and look for price to trade below that point of interest, which was created by our virgin wick level getting closed through. After price trades below the POI, we want to see it tap into a high time frame fair value gap, which is either a 15 minute, a 1 hour, or a 4 hour. This is the new thing I'm talking about. Then you want to see price form a bullish inverse fair value gap back to the upside, and you would enter on confirmation of that FVG. Stop just below the entry candle or the FVG, and then you can target the highs for your TP. That is it in a nutshell. And yeah, so this high time frame fair value gap confluence is what I'm playing with. It's what I added, it's what I tested over the weekend. Let me just show you. Yeah, so pretty much over the weekend, took a bunch of time, did some testing. I did over 200 trades. So pretty much I looked at a bunch of different months, like May, April, March, December, August, July, November, October, a bunch of different assets. So gold, NQ, ES. And then what I did was I would look for my model to play out, and then I would just check if there is a high time frame fair value gap present or not. And then if there is, I'll check it off. If there isn't, I'll leave it, and then just mark down if it was a winner or a loser, how many are profit. Actually, I'll just quickly show you on TradingView on an actual chart what this looks like and what the process looks like on actual price action. Oh, and I just wanted to quickly mention these higher time frame fair value gaps. They are already built into this FVG Pro Toolkit indicator that I know, myself and I know a bunch of you guys are already using this one. So it's really simple. We don't need to add any extra indicators. You just open this one we're already using, and you just scroll down to the high time frame fair value gap settings section, and you can just tick these boxes. I'm using the 15 minute, 1 hour, and 4 hour. All right, so here's a nice example of a plus trade with a higher time frame fair value gap present. So where am I? Let's go here. Okay. So this 10 p.m. candle closes through this virgin wick, creating your bearish point of interest there. And so from 11 p.m., you can then drop down to the 1 minute time frame and look for a short. If the POI gets engaged, boom, POI gets engaged, bang, our higher time frame 15 minute fair value gap. Looks like there's a 1 hour gap there as well. Gets engaged, then bang, fair value gap, FVG confirmed. So you'd have to be pretty quick with the entry on this one. You do get a bit of a chance to enter, but yeah, you gotta have some quick fingers there. But still, that just dumps straight down. So really nice example. It's A+, it's got everything you want. All right, here's another one on gold. So we've got this 8 p.m. candle closes bearishly through this virgin wick, creating your hourly bearish point of interest. Then from the 8 p.m., is that 8 p.m.? Yeah, 8 p.m. candle, you can drop down to the 1 minute time frame. Look for the POI to get engaged. It does get engaged. Now we want to look for an FVG along with a higher time frame fair value gap. So there's our high time frame fair value gap as our indicator shows. Boom, FVG gets engaged. And let's see if we have an IFVG. Maybe we don't. Okay, there we go. I fixed it. My indicator was glitching out for some reason. Okay, let me go back there. And if it wants to load, you'll see, bang, there's your IFVG. You can put your stop up there. Targeting 2R, you can even be a bit more lenient with the stop, something like that. Bang, bang, bang. Beautiful. There you go. All right, another example here. A plus setup with the FVG, high time frame FVG present. So bullish trade candle closes over this virgin wick, creating your bullish point of interest. Here is your hour, your execution hour, 11 p.m. Drop down to the 1 minute time frame. Now, let's watch. Boom, into the M15 fair value gap. IFVG confirmed. Enter there, stop loss just down there, targeting 2R. Beautiful. Very nice. All right, another example here. So 9 a.m. candle closes quite strongly through this virgin wick. And maybe, yeah, that one as well. So these are your bullish points of interest, where you drop down to the 1 minute time frame from 10 a.m. and look for your entry if the POIs get engaged. Let's see. And it looks like we do have some M15 fair value gaps as well, which just got reacted off of, followed by a fair value IFVG. So beautiful looking setup right here. Nice draw on liquidity up here. So you could enter there, put your stop somewhere down there, targeting 2R. And let's see it play out. Bit of drawdown, bit of chop, but it looks like it does eventually want to take it. Boom, there you go. So it was always going to take that draw, just took its time. Very nice setup. All right, we'll do one more A plus example with a higher time frame fair value gap. So we've got this bullish trade candle closing through this virgin wick, creating a point of interest. So then from 10 p.m., drop down to the 1 minute time frame. POI has been engaged. There is your FVG. Okay, there we go. The FVG was not showing for some reason, but okay, POI gets engaged and we drop into a 15-minute fair value gap. So all we need now is an IFVG. Okay, there we go. Bang, you can put it just below the entry candle or the IFVG, whichever is safer. I would go something like that. And you can target these highs. Yeah, something like that. 2R. Boom. You get a few minutes to set your limit order, and then bang, straight to TP. Beautiful, beautiful trade. But yeah, if you want to see more examples, in the Bible document, there's like, I don't know, at least 10 examples in there. You can have a look through them just to get a good feel, a good eye for what the setup looks like. All right, so now that you've seen how the trades work and how I got the results, here is the final result table. So when there was a higher time frame fair value gap present, It's a 57% win rate. When there isn't, it is a 46% win rate, so almost actually more than a 10% increase, and almost double the expected R per trade. But yeah, the funny thing is the net profit at the end is almost the same, pretty much the same, about 50 R. So yeah, even though it's pretty much the same profit, like net total profit at the end, you do get a higher win rate, which means less trades, because across the same time span, you're taking... So if you just took every trade, it would be 211. But if you only took trades with the higher time frame fair value gap, that would be 75 trades. So yeah, like less than half the trades. So less time on the charts, which also means less losses, less stress, less fear, less greed, just less emotions, and a better expectancy per trade. So for me, I think it makes sense to have this extra confluence, even though it doesn't change the total profit that much. I think I would prefer to have a higher win rate. But yeah, like I wrote down here, I don't think there is a correct, I don't think there is a right or a wrong. If you like to take more trades, but then you want to have a lower win rate, then go ahead. You should go with less confluences and less rules and not add in extra layers. I think of it as like a spectrum. So on the far left end, you've got like high frequency, super low win rate, but like not many confluences. So like you'll take everything. As soon as price touches the POI, you enter a trade. And then on the other end, you've got a lot of confluences, so lower frequency of trades, but then a higher win rate, where you need price to be at this exact time on this exact asset. You need these things to line up, and you might get like one trade a month. So I think it is important to find where you fit on that spectrum, along that line, and where on the spectrum suits your personality and your preferences, your psychology, your lifestyle, and where you fit best on that spectrum. But yeah, another potential solution if you want a higher win rate, but you still want frequency, is to just add more assets. Like you can add NQ, ES, gold, silver, oil, Forex, like euro, dollar. So you can artificially increase frequency that way, while still having all these confluences. You can also add another entry time frame, which I might look into. So for example, you can add the 2-minute and the 3-minute entry time frame, meaning everything else in the model stays the exact same. You're still looking for 1 hour points of interest from Virgin Wicks. But you can look for inverse fair value gaps on the 1 minute, the 2-minute, and the 3-minute. Yeah, these are just ideas. So, but it's up to you what confluences you want to use, how frequent you want to trade, how much of a win rate you can tolerate. But yeah, that's my whole take on adding this extra confluence. I'll just go over what the Trading Bible looks like now that I'm adding this. Yeah, so since you saw, the results are pretty good for adding a higher time frame fair value gap as a confluence. So I'm officially updating my trading rules, my strategy, my Trading Bible, as I like to call it, where I will need a higher time frame fair value gap present in order for me to take the trade. I've also added a bunch more examples here. I'll share this with you guys so you can have a look of what the new model looks like with the higher time frame fair value gaps. And I've also added ES just because, like I said before, when you're adding more confluences, you will have less trades. But with adding an extra asset, you might get a couple more trades throughout the week, because sometimes trades might not show up on NQ, but then they might show up on ES. You can also probably add silver because it's correlated with gold, the same way that NQ and ES are correlated. But what I found with silver is, even with micros, if you try to place one trade, just like a normal trade, like a normal stop loss, if your stop loss gets hit, it's like $400 or $500, which is unacceptable risk for a 50K account, because I only like to risk about $200 per 50K account. So I think if you're trading larger accounts like 100K or 150K, then you can stomach a $400 to $500 risk per trade on a silver micro contract. But for me, I'm only trading 50K accounts. But yeah, so these are the assets. These are the session times. New York AM is optional for me. I've noticed I've missed some trades, but for me, it's like bedtime for me. So if I'm up, I'll take it, but most likely I might skip it unless it's like super early at 9 a.m. Yeah, just an overview of the strategy. Wait for H1 candles to close above virgin wicks. The virgin wicks then become your bullish points of interest. Then drop down to the 1 minute and look for price to engage the POI by trading below it. Then wait for a confirmed bullish IFVG, and the IFVG can be on either side of the POI. And then you can enter. And price must be within a higher time frame fair value gap, or it must have recently reacted off a higher time frame fair value gap. Enter trade. Here's a nice visual example. Opposite for bearish setup, obviously. Here's what a bearish setup would look like. TP and stop loss rules are the exact same. Stop loss is just on the other side of the IFVG, or the entry candle, whichever is further. TP is at the obvious drawn liquidity, or 2R maximum if the drawn liquidity is more than 2R away. If it's more than 2R away, significantly, I will widen the stop loss a bit and lessen the TP a bit, so I can maintain a 2 risk to reward with a bit of breathing room on both sides. No partials, no moving stop loss, no trailing, no break even, either stop loss or take profit. Risk is the same. Contract size will depend on how far the stop loss is. Yeah, here's another example. Nice tap into the fair value gap. I updated this section with my IFVG higher time frame settings. Oh yeah, I forgot to mention this. Fortunately for us who already trade this model and use the IFVG Pro Toolkit indicator, it has a built-in higher time frame fair value gap function. So you don't need to add any more indicators. You literally just tick these boxes and you're good to go. But that's what it looks like from my indicator. Yeah, rules are the same, except we just need to be within or recently reacted to a high time frame fair value gap. Process is exactly the same, except we are waiting to see if price reacted to a fair value gap, as you can see here. But yeah, that's pretty much it. Again, I'll leave this below. And yeah, there's a bunch more examples here. You can have a look through these in your own time. And that's where we're at. Hope we have a good week of trading.